Hi, everyone, and good afternoon. Welcome to Stonehearth Capital Management's quarterly update webinar series, CIO Corner, featuring our Chief Investment Officer, Chris Gauthier. I'm Ben House, Associate Advisor at SEM, and I have the honor of being today's host. Before we dive into today's discussion, just a few quick housekeeping notes. Please use the Q&A button at the bottom of your Zoom window to submit any questions throughout the webinar. We'll aim to answer as many as possible during the Q&A portion at the end. If we happen to run short on time, either Chris or I will follow up with you directly to ensure your questions are addressed. Now, I'm excited to introduce today's speaker, Chris Gauthier, Stonehearth Capital's Chief Investment Officer. He has over 25 years of experience in investment management. He leads our firm's investment policy and strategy, focus on asset allocation, risk management, research, and portfolio management. Chris, thanks so much for being here. I'll hand it over to you.
Thank you, Ben, and nice job on your first CIO's Corner webinar introduction.
Thank you.
So thank you very much. Good afternoon, everyone. Thank you for joining us today from tropical Massachusetts. If you're in the Northeast, I hope everybody's trying to stay cool here. And really, thank you for joining us for the second quarter CIO Corner update. Interesting times we're living in. I know we always say that, but there's just so much rhetoric, uncertainty, emotional in the political arena. You got tariffs on again, off again, and everything in between. It is really tough to make sense of it all. For us here at Stonehearth, as stewards of our clients' hard-earned capital, we rely on the empirical data, based on historical evidence, precedent, which drowns out the noise and allows us to focus on what is really important to clients' financial success. And that's what we try to do with these presentations. So with that, we'll start with where we have been, try to set the stage for where we may be going, and then take a deeper dive into the current data and what that may tell us about where we're headed in this turbulent time. So looking back at performance, Q2 2025, we saw a nice strong bounce back, right, from a weak Q1. It feels like it's been forever since we spoke, but we got to remember that going into the tariff craziness of April, we were starting off from a very weak perspective, right? The 2025 did not start off good. So we saw a nice strong bounce back for the majority of the assets, really led by the NASDAQ. Anytime you hear the NASDAQ, you think about the Mag 7, and you can see that on the screen in blue, like all the US equity had a very strong Q2 2025. But again, we saw some strong returns from other asset classes too. When you look at overseas assets like Europe, Japan, China, those are in green here. You can see that, not far behind and actually ahead of the more broad-based US indices like S&P 500 and the small cap. In yellow is everything that's not really included in the equity land. You can see that gold. She slowed its upward momentum a little bit, but, still delivered a very positive, very healthy, almost 6% return in the quarter. Bonds joined gold as well. They had a very decent return. You saw high yield, the most riskiest parts of the bond market, up almost 4%. But even when we look at the corporate bonds up 2%, and more the broad-based bond market, when you include treasuries, still up a very healthy 1.3% in the quarter. Not as good was oil. And especially the dollar was the worst performing asset, almost down 6%. In fact, it's had its worst half-year performance in over 52 years, leading to the downside. Really based just on deficit and potential tariff impacts on global trade. So again, looking at the quarter, overall, strong performance, most asset classes, really on the worst case being avoided on tariffs, and another strong earnings seasons from equities. So that kind of sets the stage for where we've been. And now we want to look forward, and we'll start with the current macro environment, focusing on, as always do, finding the signal through the noise. So what we're looking at here is the U.S. economy GDP. You can see in the line here, this dotted line is the trend growth. You can see about 2.1%. And you can see at the current readings, we are still healthily above the trend rating. Although on a quarter-over-quarter basis, we did see a slight drop. We're looking at Q1 data because it does report with the lag. It takes time for all the economists to gather all the economic data. But again, the signal is we're still above trend and growing. it was a very noisy number, and really due to tariffs. So you look on the right-hand side, you see the components of GDP. That's what makes it up. You see it's driven by consumption, almost 70%. That's consumer. But you can see the real drag was from net exports, down almost 4%. But if we look into the data, and the next slide, we decompose this data, it's not as bad as it seems, right? Looking at the data, you get a much clearer picture of the economic environment, and it really points to a much brighter economic outlook. So looking at this bar over here on to the right, that is a Q1 2025 GDP report, and you can see the big drag from the tariffs here. But above that, you see almost everything else is positive. Consumption, right, which is 70% of the economy, is up 0.3. Business fixed investment up 1.4. Flat government and residential spending, and then final sales to domestic purchases up positive, right? So the big driver, the net exports to the negative print, and that's just really front-running tariffs, a little bit of pull forward, and likely to reverse as trade normalizes in the new regime. All those other data points we just mentioned, business fixes, fixed investment, consumption, all point to an expanding economy. So the data that's likely to be sticky looks positive. And we're also seeing the same thing when we look at the growth surveys. And what we're looking at here is PMI, ISM services, PMI, from a manufacturing and services standpoint. Now, as I've mentioned before in these webinars, this is a diffusion indice. So it's not looking at what happened. It's a questionnaire. The government runs it, or in a private entity runs it for the government, goes out, asks business all kinds of questions, long list of questions, and they have to answer getting worse, staying the same, getting better. Add all that up, and if it comes to above 50, it points to an expanding economy. If below 50, it points to a contracting economy. So we look at the individual pieces of it. You see red is the services, again, making up 70% of the economy. You can see that's a very healthy 50.80. Services is still an expansion territory. And then we look at manufacturing, and we can see that it did have a slight dip. It was shallow and really looks to be recovering nicely up at 49. So again, when you look at it as a whole, look at the data that actually matters, you see it pointing to an expanding economy and really driven by services. When you hear services, you think consumer. And the consumer is really finding support from a strong labor market, as can be seen from the low unemployment rate, which is this brown line. You can see at 50-year average, 6%. Right now we're at 4, so we can say that we're at full employment with some friction, right? And we're also looking in the blue line is wage growth. We see very strong wage growth at 4%. So on the aggregate, this is not everybody's individual circumstance, but when you add it all up, wages are growing over 4%, and we have inflation a little bit above 2, which we'll take a look at in a few more slides. You can see that people have more money in their pocket. We do expect this to continue. Again, multiple things. We see an expanded economy from the services, but we also see immigration, right? And so as we have immigration crackdowns, that lowers the labor force and increases wages and lowers the unemployment rate. So again, we do think there's continued strength in the labor market moving forward. And just again, remember, when we look at the labor market, we always want to kind of use the KISS principle, keep it simple, right? More jobs, more money means more spending, all go to support the economy and flows through the corporate earnings, which drive stock prices in the long run. Now, it's not all rosy in consumer land. There are some negatives. And look at that top chart. We're looking at 90 days delinquents. You can see this red line there with the big jump up. That's student loans. I'm sure you probably heard that we started resumption of collections of student debt and will cause a big jump in loan delinquencies. Also accompanied the steady rise in delinquent credit card debt, which can be seen on that blue line. But again, trying to find the signal through the noise, looking at the data, it's not as dire as that top chart suggests. Since when we break out the data further, and you can see that at the chart below that, you can see it is very concentrated, right? So the percent of consumers with collection is actually declining. Now, that's not good for those consumers who are delinquent. We feel really bad for them, and everybody has some tough situations to deal with. But you can see that's really very concentrated in a small pool of low-income borrowers. And you can see that those collection amounts are actually getting worse. The takeaway, again, not the individual personal circumstances, but for the economy as a whole, is that we're not seeing consumer credit, despite the weakness, It's not a systematic problem for the economy yet. It may turn into that, but as we're looking at the data right now, we don't see that. So it's another support for the economy from the consumer. So other thing that's really positive for the economy right now is the stabilization of inflation. Now, what we're looking at here is multiple ways to look at inflation. The top chart is US Consumer Price Index in orange. So that's everything we pay. And remember, that is a growth rate, not a level. So if you go from 5% to 2%, it doesn't mean prices are shrinking. It just means prices are rising less fast. And you can see based on the latest print, which was yesterday, we have the consumer price index still rising at 2.67% per year. We look at the chart below that in blue, that's the core that takes out food, that takes out energy, and that's even higher at 2.9%. Then we look at the one in purple, producer price index, which is those input prices we talked about, a little bit lag on the data, but still we're at 2.6%. So again, a long way from the Fed's stated target of 2%. Still a ways to go, but stabilization, even at these higher levels, removes a big risk, right? We don't have that hyperinflation risk out there. We don't have deflation risk. That stability really helps markets because it allows for fundamentals to have that larger impact on price action for equity markets. So again, not mission completed yet on inflation, but definitely getting there and not really hurting the economy right now. Uh, it is not all good for the economy. I know I showed you a lot of positive data. We still have some issues. I don't want to scare anybody, but we have to deal with it. And we're going to talk about government debt here on two charts. Not going to spend a lot of time on it, but the 32 trillion, and yes, we do have 32 trillion in public debt, is the federal government debt, right? And we can see on the left-hand side, the federal debt by public percent of GDP is as high as it's been since World War II, right? And we had a war fighting back then, so you can argue that we really need to spend the money. And you saw it come down tremendously after that. We don't see that. And this is a prediction by Goldman Sachs, but again, they're pretty much in line with everybody else out there that there's no slowdown and no decrease in the percent of GDP in debt. And if things stay the same as they are now, we're over 100% by 2034. Then we look at the deficit, right? So this is what the net deficit we have, and we're at 6% right now, headed to 7%. So no correction there, right? So it looms large and it will have an impact, right? But the timing is the million-dollar question, as is a question of confidence, right? And debt is always a confidence. Is our investors confident the government's going to pay them back? And right now, the markets remain confident. The question is, but for how long at these levels? We'll have to see. But for right now, it's still positive. And again, do have to mention, this is before the big, beautiful bill passed. So you want to add another 3.2 trillion to this, and those deficits get even larger. And we can see that it's only going to add to our fiscal issue as interest payments are rising to the stratosphere. We see the federal interest payments in blue, we see the state in red. So putting it all together quantitatively, the government is spending $1.36 trillion just in interest. So think about your credit card debt, just that interest payment. That's what the US government, and in turn, us taxpayers, are paying every year to fund this debt. Definitely not sustainable in the long run. And we're just borrowing from our children and grandchildren's future, right? Someone's going to have to deal with this and the fallout. But for now, in the shorter term, the deficit, it does act as a stimulus. It does throw money into the economy, which supports further economic growth, further economic expansion, and flows through to financial markets. So given all this economic data, what does the Fed and investors make of this data, right? And really, despite the strong job market we saw, the still elevated inflation, and lack of concrete data on tariff levels, which will impact price levels at some time, market participants are still calling for 2 to 3 rate cuts in 2025, as can be seen on the green line in the next chart. And again, this is from our friends at JP Morgan, and this solid brown line is where rates are, and right now they between 425 and 450. They always give a range now, and you can see market participants think there's going to be 2 to 3 rate cuts this year. The blue is the FOMC, which is the Federal Market Open Committee, and they see a little bit less. Again, not sure we get to, right? We saw the economic data, we saw the strong labor market, we saw inflation not there yet. But it is something we're watching, right? And President Trump is jawboning the current Fed chairman into lowering rates, even threatening to replace Chairman Powell if he doesn't get what he wants. And for those who are playing the game, watching the market today, you saw this big sell-off at 10 o'clock, and that's because there's this rumor that he actually is going to replace Powell. So again, to me, that is the greater risk to the market rather than the level of interest rates. Really, because as the removal of Fed independence would potentially have massive negative consequences. We heard Jamie Dimon talk about this yesterday for financial markets. Again, it just moves us away from that more developed economy, more like an emerging market. That being said, in interest rate environment, as long as we have stability, stay in that 0 to 2 cuts. With the Fed retaining its independence, the market will be able to ignore the noise. The problem is we don't know how much is going to be noise and how much will be data with what we've heard from President Trump today, but we'll have to see and wait how that plays out. So closing the loop on the economy, this is a chart from our friends at Ned Davis, and what they're looking at is a model that has historically been a pretty decent predictor of recessions. It's a probability, right? It's not a guarantee, just a probability. And we see the data going back in time, and when it rises and rises quickly or gets to above 70, you typically have a recession, which you can see in these shaded areas. We look at the current data, and what it's telling us now is that there's a very low probability for a recession based on their internal modeling. And we agree, right? The signal from the data is really supporting further economic expansion in 2025, which should in turn help financial markets. So speaking of those financial markets, let's turn and start with the equity market. And as always, we'll start with valuation. And what we're looking at here is the forward-looking PE ratio from the S&P 500 index going back in time. You can see the 30-year average of 17, definitely above that at 22 right now. And you can see it's even above that one standard deviation line, which means that we're really very elevated. We look at other valuation measures. You can look at the call-out box, Shiller's PE. It's a similar to the PE ratio, but just looks over a 10-year period. It takes out inflation. That shows it's overvalued. Dividend yield is low, earning yield. So again, we're definitely in an overvalued market. So there's no relief from a valuation standpoint. We did see earnings, which is in the denominator of the PE ratio, have come in stronger, but that numerator, which is the price, has risen faster, indicating investors are willing to pay more for $1 of earnings, which is called multiple expansion, right? Which I'm sure you've heard about. This can be best measured by investor sentiment. So it's just investor sentiment and those animal spirits that are driving the stock market higher in the short term, not based on the fundamentals yet. But despite these lofty valuations, especially the headline indices, there are pockets that are not trading so rich and may provide some opportunities for investors willing to look for them. And what we look at here, and there's a lot of data here, but we're looking at different equity markets. That top bar is US styles, the S&P 500, the large cap indice that you know, mid cap stocks, small cap stocks to bring out value growth. And you can see the different regions run underneath that, international, Europe, emerging markets, and then it breaks out by countries. So the big takeaway looking at this is that when you're looking for green, right? Green is good, which means it's trading cheap compared to its history or compared to the total equity market, and red means expensive. So, first glance, you take a look, international small cap, Latin America are looking pretty attractive from a valuation standpoint. And maybe provide opportunities for investors where you can tilt into those asset classes a little bit and get a little bit more performance boost because it's starting at a much better valuation picture. Now, for those of you who have turned into this webinar over the years, you shouldn't look at valuation, right, in isolation. There are multiple drivers of stock prices, right? Macro, sentiment, fundamentals, technical, and of course, valuation, but they should all be considered before investing. And you want to use a weight of the evidence approach. So now I'm going to kind of go through some of these other factors. We'll look at some technical data, look at the sentiment data, we'll look at the fundamental data, because we know the macro data is positive, but what is this other data telling us? So we'll start with the technical, and what we're looking at is the S&P 500 index, which is this black and red line. Red is when it goes down, black is when it goes up. You see some moving averages here, longer term red, shorter term blue. Big takeaway, I love this chart because it gives you a good visual of what's going on in the market. You see the onwards and upwards since the tariff tantrum in the beginning of April. It reclaimed its 50-day moving average. Again, remember, we like reclaiming moving day averages. It's firmly above trend and support, which is this red and green line here, and healthily above that, right? So again, strong technical backdrop, has good technical support. We're also looking at momentum in this chart, which can be captured by this MACD down here. And basically what it's just comparing a short-term momentum to long-term momentum. The takeaway is it's strong when this black line pierces through the red line on the upside, which we saw it did at near the end of April. So again, strong from a momentum side. Look at the top chart, which is the RSI, which is Relative Strength Index, is trying to find inflection points when it gets too frothy and when it gets too oversold. You can see it's right in the middle, so it's not giving you a big indication one way or the other. So overall, just looking at upward sloping moving averages, the index trading above the moving averages, positive momentum, not elevated or extreme RSI readings, you can end up with a very strong technical backdrop, which should support future price appreciation. Sentiment, not as strong. And what we're looking here again from our friends at Ned Davis is a crowd sentiment poll, trying to measure those animal spirits. Our investors just getting a little bit ahead of their ski tips here in the marketplace. And you can see that off the April lows, they are a little bit, right? You saw the market rise, you see the sentiment increasing. It's getting to frothy levels, it's getting elevated, approaching concerning levels, but not there yet. And like we said, it's just one input. You have to look at the totality and the weight of the evidence. But for now, sentiment seems a little bit frothy here. You could get a little bit of a pullback maybe in the summer months, but it should be shallow and deep because when we look at the other inputs, they're much more positive than sentiment. And lastly, we'll look at fundamentals. Fundamentals appear strong. And we talk about fundamentals, we'll talk about earnings, right? And earnings season is upon us. We just had our first few companies report yesterday on the financial sector, and they had pretty decent earnings. When we look at Q2 earnings season, growth estimates are muted, right around 4%. But as you can see from this chart down below, the expectations are headed upwards. And what we're looking at here, this chart below, is just looking at the S&P 500 companies. Those that analysts are raising their estimates, who think they're going to do better, compared to those analysts that are lowering estimates, right? So again, smooth that out over time, and you get a number above 27, which means more analysts are getting bullish. You can see that historically, you get a pretty good gain in the marketplace after that. So again, when we look at earnings, it's not really the level. It is what are the estimates and are they actually growing? And for now, we see that the expectations are headed upwards, which historically has been a very good sign for equity prices. So closing the book on the equity land, mixed picture, right? Some a little bit frothy sentiment, but strong momentum and technical picture, definitely overvalued, but some pretty decent earnings. You put that all together in the overall weight of the evidence, it leans positive, especially if you're able to move away from some of those highly concentrated headline indices in the US. So again, that's where we stand from an equity land. It's not all equity out there. We do know there's fixed income out there. So let's take a look at the bond market. And the bond market beats to its own drummer, right? It does not follow the equity market, lock, stock, and barrel. And it has a very different viewpoint than equity investors. And we can see that in the rate movement in the quarter. We saw rates mixed in the quarter with the short end down. That's this green, right? So that's the 1-year treasury rate. So you can see from the end of the quarter, that is actually down a little bit, which is good. You look at the longer term rates in pink, which is the 30-year treasury. It's up at 4.78 at the end of the quarter. It actually pierced 5 yesterday. So again, that's even higher. So you had rates mixed in the quarter, right? Short end down, long end up. And we call that in fixed income land a bear steepener. All that is referring to the shape of the curve, and what it means is that expectations of higher inflation ahead are driving that long end of the curve, and which is rising faster as the short end's coming down. So again, the bear steepener, as the name implies, is that the Fed's going to have to raise rates. Not what we're seeing from the data on the Fed chart, and not what we're seeing in the equity land. But overall, when we look at rates here, still down year to date, which does help corporate America, right? And the consumer, because we know we have debt out there in the short term, and the government, by the way, too. So that's a good thing to keep in mind, as both have high levels of debt. but the bond market is implying that it's not sustainable in the long term, like we talked about, which is why they're implying higher long-term rates on that 30-year bond. So again, both could be right, right? As inflation and debt are more long-term issues and confidence, we don't know when that hits, and you get stimulus from government spending and animal spirits, if you saw sentiment is elevated, are more short-term. And as always here at Stonehearth, we'll let the weight of the evidence and the data be our guide. And looking at a part of the fixed income market, which is credit, and what we're looking at here is corporate bonds and high yield bonds. And so corporate credit market is just a subset of that fixed income market. This is more in line with the equity thinking, as spreads or what banks and private credit funds charge above treasury rates to lend to corporations are muted. And that's right here. So you can see the high yield in blue, right? As expected, you charge more for high yield companies, which tend to be more riskier than more corporate companies, think like Apple, here. But again, this is just showing the spread over treasuries. Just, how much do banks think and how much they want to charge extra over treasuries. So when it's historically, it has acted like the canary in the coal mine, right? Tighter spreads, mean banks and PC and private credit funds have confidence in companies' ability to pay them back and require lower interest rates to lend. Works opposite. When spreads widen, they're getting more nervous. So when we see tighter spreads, we have more confidence in the future economy, and you should see economic growth. And with rates as tight as you see in the chart on the left, and levels currently below long-term averages, which could be seen right here, the long-term average of 20 years is the blue, and you can see in the green the current rate is at all below, for all levels of credit, are below the long-term averages. So again, when we see this, it points towards a healthy stock market and healthy financial markets. So fixed income does remain an attractive place to invest despite the higher rates, right? Not only for ballast in times of turbulence, but also for return, right? So higher rates do act as, some kind of positive for savers. And we have higher rates than we have compared to recent memory. The Fed put the income back in the fixed income market, right? So what we're looking here is different parts of the fixed income market, treasuries, munis, again, corporates that we looked at in the previous chart. You have mortgage-backed securities and commercial and asset-backed, think car loans, credit cards, and then the more aggressive, right, EM debt, some high-yield debt. But what you want to take away from this is when we're looking at history, and this is using the past 15 years, this brown bar is just where rates have been over the past 15 years. Putting it all together, you get an average of 1.6. And remember, we had the low interest rate environment, almost Fed rates near zero. So there was nearly no income to be had. So when rates moved, you had some weak fixed income. You didn't have enough income to offset price movements. Now, our parent average, you look at treasuries at 4. You look at asset backs up at 5. If you're willing to take more risk, you're up at 7 for high yields. So again, you have some income to offset some of that price appreciation. And in addition to providing protection, it also provides a return now in fixed income land. So again, we still think it can be an attractive piece of an investor portfolio and part of the solution to meet clients' financial goals. So that's where we stand from a macro environment. That's where we stand. We saw from the equities, fixed income. Now I'm going to try in the next few charts, putting it all together, wrap this all up. What does this mean for client portfolios? What does this mean for the risk environment? What does this mean, hopefully, going forward for 2025? And we'll start with, again, from my friends at Ned Davis and their Fab 5 model. This is based on 30 different indicators broken down into 4 categories, which can be seen in the box down here. Below tape, here tape, you think technical. They think this is one of the most important factors, so they count it twice in their model. We look at sentiment. Again, we saw that was bearish. We saw monetary. That's the economy, credit spreads, and see that's bullish. And combo is some other models they use to pull into this model to get a good idea of what's going on in the marketplace. And we look throughout history, this has a pretty good record, right? So this is going back to 1981. When it's above 1.5, you tend to get a gain of almost 27% and 40% of the time. When it's between negative 1.5 and 1.5, you get a gain of 8. Not bad, but again, still a little bit muted, and that's a little under half. And then below 1.5 is where you don't want to be, and you get those negative returns. So looking at where it is right now, it's at a 2. We saw tape, very positive. Sentiment, again, a little elevated, and monetary positive. No signal from combo. All points to a very strong NDR Fab 5, pointing to higher returns moving forward. Again, No guarantee, not 100%, but you may line the data and you put the probabilities in your favor that the market is going to be headed higher based on this modeling. And then like NDR, we have a model as well, and we saw improvement as well. So we did see a big jump in the technical since we last met, and we last met in April, I believe. So it's again as of 3/31. This is the current as of 6/30. And you see from a technical, which we break down the structure and reversion, which you can see over here how we look at that, that it was very negative at the end of Q1. Big change, right? We saw the big bounce up in stock prices, really saw the moving averages be reclaimed, saw a little bit of better breath, and we end up at a +2 from a technical standpoint. So again, still positive. S&P 500 is still overvalued territory, and despite some of those pockets of valuation support, valuation overall is still negative. It has been for a while, and we saw it last month, no change to that. Macro, we saw in the beginning of this presentation and continues to be a positive influence, and it is in our model here at 2. Again, we did see a little bit of weakness in there going from 4 to 2, but not enough to tip it to negative. It's still positive influence. And then that qualitative piece is really anything we can't capture in a quantitative model, right? And what that's pointing to right now is a negative environment, really based on all the uncertainty. And there's always uncertainty out there, and you always hear that the market climbs a wall of worry, but that uncertainty is more elevated right now. So it's going to still act as a little bit of a drag on the risk environment right now. So even though we're still negative, we're much closer to positive, and the real big driver of that is valuation. So we do think that it's time to lean into risk a little bit more. So when we look at the entire marketplace, putting it all together, using all the data we have, the weight of the evidence, right? The evidence points to a richly valued market, although with pockets that are still attractive, elevated compared to history in a geopolitical environment, still strong economic support, and very supportive technical momentum backdrop. Right? So put that all together, the weight of the evidence and the signal is pointing towards a healthy environment, but taking a little bit more risk than normal in client portfolios, which is what we did in the quarter, right? So based on that signal from last time we met, we moved from underweight to overweight in equities, which you can see right here at the top line, with a tilt towards international assets. Again, overweight international, we saw that valuation support, still have a very healthy allocation to the US, but we have diversified away from the highly concentrated, most richly valued, think S&P 500, Max 7, NASDAQ, parts of the market. Doesn't mean we don't have exposure there. We're just tilting away a little bit into more attractive pieces of the market. So still overweight risk in client portfolios. When we look at the fixed income market in this presentation, we saw the higher rates, low spreads. We're finding opportunity in the more aggressive parts of the fixed income market, and it's reflected in our overweight position here. And finally, we get down to cash, and we're underweight cash, as to be expected, given what we're seeing from the risk environment. And when we're underweight cash, that really goes into our opportunistic bucket, which uses relative strength to pick 2 to 4 individual asset classes to invest in based on the environment. And for right now, given the fact that we're seeing these positive, it is overweight more risk assets in that bucket. So again, that's where we stand from portfolio standpoint. Always, again, the caveat is could change on a moment's notice, especially given what we're seeing in the marketplace and the rhetoric coming out of Washington and the executive orders. But for now, again, it's not as bad as it may seem out there, and not as bad as you may have hear when you look at the data through the noise. Well, let's kind of sum up what we went through today, take some key takeaways. So again, political rhetoric is here. It's going to stay. It will have an impact on prices, but it tends to be more short-term fluctuations. So to prevent from getting caught up in all that, you focus on the data and really find that signal through the noise, which we're seeing is positive right now. And really do the consumer, right, and global economy. It shows sign of a little bit of weakening, but still operating from a very strong position. Again, remember, it may not be as bad as it seems compared to the headlines you're reading. Despite high valuation in parts of the equity market overall, still positive technical environment, strong earnings momentum. So again, it's all right to be tilting into equity in that type of environment. Bonds remain attractive. Again, the Fed has put the income back in fixed income market, making it more attractive than it has been compared to recent memory. Weight of the evidence, like we saw in the multi-factor risk models, positive technical backdrop, positive macro backdrop, positive monetary conditions, all offset by negative sentiment and valuation, while not giving the all clear, pointing to further strength in risk assets ahead. And finally, going forward, as always, diversification, risk management is really going to be key in navigating these markets for the remainder of 2025. And you investors must remain flexible based on new data as is presented. So again, I want to thank you all for kind of sitting through my presentation here. This is the appendix. There's the compliance disclosures. And now I'm going to turn it back to my colleague Ben to see if there's any questions out there from the people listening to the presentation. Ben?
Chris, thank you. That was great. Yes, we have a few questions here. Let me share one with you right now. First one is, how did the passage of the beautiful bill impact our portfolio? And did you make any changes?
Beautiful bill. Um, Again, he's referring to the big, beautiful bill, which is, the budget reconciliation bill that recently passed. It's over 900 pages long, so a lot to go through there. But, despite the length of it, it really didn't have a big impact, right, on our portfolios or even in the markets, right? We saw proof of that, as the muted market reaction on the passage of the bill, right? Markets are always and forever future discounting machines. So most of it was already priced in, since really the majority of the opinions that was going to pass, pretty much everybody knew most of what was in it, a few changes here and there. So there's really no surprises and no impact to the markets on the overall. Taking it from a 10,000 foot level, looking at what the impact's going to be, slightly overall positive in the short term for the market as tax rates aren't rising. That's a good thing, right? But keeping the same rates as before is not new stimulus, right? It's not new tax breaks. You're just kind of keeping it as is. Raising the debt ceiling, which is part of the bill, yeah, that's good, right? We're not gonna have that drama go on anytime soon. Good for the short term, but not long term. There's a whole bunch of R&D tax breaks. Again, helps short-term earnings, but again, that just kind of pulls forward from future investment. So again, borrowing Peter to pay Paul. You're just borrowing from the future to support the present. To me, looking at the bill and reading through it, and I did read through it, which is, interesting Saturday night there. The real impact of the bill is to the tax code, right? Personal taxes. They have new investment accounts for kids. There's some SALT adjustments in there. Tax code changes for seniors, tips, overtime. To me, this is the real meat of the bill. And when I see all this stuff, I always go to my a senior advisor here at the firm, David Giuliano, to get really understand what's going on with all these tax implications. And I was just speaking to him the other day, and he's wrapping up a presentation on all these potential impacts for our clients. So I'd be on the lookout for that, and really, stay tuned for that to come through because that's going to really the meat. It's really going to affect most of our clients. So look out for that presentation from David coming out soon.
Very good. Second question is, would you mind expanding on how the market's been reacting to President Trump's tariffs?
Yeah, yeah. So again, multiple ways, right? So thinking back, and again, it feels like a lifetime ago, but it was only a couple months ago in April, with the announcement in the Rose Garden. After that big sell-off, with that initial announcement, subsequent bounce back after the announced tariffs were delayed, right? They're really not having a big overall impact, right? We're seeing some impact at the micro level. Like we saw a big rise in copper prices when he put his 50% tariff on. We did see a nice bounce in US steel stocks on steel tariffs. But in general, I think investors are just viewing it as noise for now, right? Like the debt is a confidence game. President Trump makes an announcement, talks tough, walks it back, then negotiates and pushes the impact date into the future. The new date now is the beginning of August, which changed in the beginning of July. So I think the market expectation is that in the end, we'll just get a slight rise in tariffs, but nowhere near what was announced. And given the current strength of the economy, it can probably handle it without going into a recession. That being said, all bets are off. If any headline rates are implemented, the market will react and it will react negatively. We don't see that happening. And again, Treasury Secretary Bassett was out there today saying U.S. isn't going to rush into any deals because of a market deadline. So again, it's just all this push and pull and a lot of rhetoric and trying to find the signals from the noise. And I think the signals of the noise right now is that it can be ignored mostly, and they're going to have little impact. And with the economy so strong, it should be able to handle at least a little bit of tariff rise. But if anything comes on the surprise that a really higher rates, like you think you mentioned today, He came out with 2,000%, 200% on pharmaceuticals, and maybe on chips too. But again, he has a grace period of 1 to 2 years. So again, as long as those big numbers are implemented, the market and the economy should be able to handle a little bit higher tariff rate.
Hmm, really good. Final question here is, will equities keep climbing after 2 strong years? And is it still okay to buy them?
Million dollar question, right? And I hope they do,
Mhm.
right? Nice to see equity markets rise. It's always good, helps all of us. Um, Let me just say the data and evidence does point to further price appreciation, right? We saw that throughout the presentation. But our risk modeling hasn't flagged risk on yet. But we are selectively moving further out the risk curve, right? History shows bull markets don't die of old age. So if it's 2 years, 3 years, 4 years, 1 year, doesn't really matter. But they're really pushed, right? By a couple different ways. An external shock, think a war or something like that. A contraction of the economic cycle, that's too much credit going through, or people assume was pulling back, a debt issue, or a financial bubble bursting. While none of the above can be taken off the table, the current financial conditions and weight of the evidence do not provide support for a current collapse in equity prices. Not 0%, but the probability of a sell-off is really not elevated here, which is what we're trying to capture with our risk model, right? Just getting us on the right side of the probabilities. So if you're contributing to your portfolio and you're at the proper risk level, right, which is the most important thing, making sure you're at that right risk level, then it's fine to be adding new money to your portfolio, which should be including adding to stocks.
Very good. All right, that's all the questions I had. So thank you all for joining. Um, we hope you have a very nice rest of your day, and always feel free to reach out to Chris, myself, or anyone here on the team if you have any follow-up questions that you think of as you go. Thank you
Thank
again.
you.
We'll see you next quarter.
Thank you, Ben, for hosting this. Thank you, everybody, for joining. And again, be on the lookout for that email from David Giuliano. I know I'll be listening to that webinar very closely because there is a huge amount of data to unpack in that tax for the taxes on the big, beautiful bill. And again, enjoy the summer, and we'll see you in the fall. Thank you.
Thank you.